Please confirm you can hear me clearly.
Yeah, yes, sir.
Good evening, sir.
All right.
Good evening, sir.
All right, good evening. Tonight, new capital rationing. Last week, we have completed capital asset decision, capital replacement decision, asset replacement decision. Tonight, our topic is capital rationing. You can check page 86. Or page 90, between the of your study pack. This is capital rationing. Where company is with capital rationing? How can we decide how to allocate available capital in such a way as to maximize our profit? You can define capital rationing as a situation where a company cannot undertake all positive net present value projects. Capital rationing can be defined as a situation where there is such because there is shortage of finance, we cannot undertake all positive net present value projects. So you can define capital rationing as a situation where a company cannot undertake net present value projects because of shortage of funds, budget ceiling, or budget ceiling placed on capital expenditure. In summary, capital rationing, situation where there is no sufficient finance to be able to undertake a positive net present value. In that situation, or it means that a company has identified a viable project, but it cannot undertake a viable project there is no finance, there is no money. Where there is capital rationing, it means that you are going to be rejecting viable projects. Projects that will have a shared waste. This project will be rejected because there is no capital to execute the project. If the situation continues, if this situation continues, that means value of the company will reduce. Because there's going to be return in shareholders' wealth. Nature of capital rationing. There are two types of capital rationing. Let's continue with class. It was a network glitch. We see there are two types of capital rationing. You have hard capital rationing and soft capital rationing. Hard capital rationing. This occurs where there is real shortage of capital. This occurs where there is real shortage of funds for investment purposes. This relates to non-availability of capital from external sources. A company does not have capital resource to finance projects. Also, the company cannot obtain capital resource from external sources. A situation of hard capital rationing. The company in question does not have capital resource to finance viable projects. Also, the company cannot obtain capital from external sources. Hard capital rationing relate to market imperfection. Add capital market imperfection. Because in a perfect market, capital is expected to be freely available where there is a perfect market situation. Capital is expected to be freely available, and as long as company is able to identify we continue with the class. We said add capital rationing is as a result of market imperfection. Because in a perfect market, capital is expected to be available freely. And as long as a company can identify positive net present value projects, it should be able to obtain finance required if the market is perfect. So add capital rationing, a situation where there is shortage of funds. The company on its own does not have sufficient funds. In addition, the company cannot obtain funds from external sources as a result of the imperfection of the markets. Add capital rationing may occur as a result of the following. That is, why will a company not be able to obtain funds? We have banks, we have financial institutions. Why will a company not be able to source finance? Why would the bank not be willing to provide loan to the company? The likely reason for add capital rationing. One, if the share prices, if a company share price is depressed, if your share price is falling, if your company's share price are falling, obviously it will be difficult to raise finance through the stock market. Your share price at the stock market is falling. Investors will not be willing to buy your shares. If you decide to issue new shares to the public, you can issue new shares, but will the public be willing to buy? If the public observe that your share price are falling, they will stay away from your shares. That is one of the reasons. Number two, the flotation cost associated with small issues may be high. What is flotation cost? If you decide to issue your shares to the public, that means you want to float your shares on the stock exchange market, on the floor of stock exchange. The cost involved in issues public may be too expensive for you. That can discourage some company from issuing shares to the public. Number 3, there may be restrictions on bank lending as a result of government control. That can create capital rationing. Governments may issue directives to banks on the amount to loan out. That means there's restriction, control. Then number 4, financial institution. Let's continue with the discussion. Financial institution may be unwilling to grant additional loan to a company that is perceived to be too risky. That can lead to hard capital rationing. Number next, soft capital rationing. Where there is sufficient fund to invest in positive net present value projects. Soft capital rationing. This occurs where there is sufficient fund to invest in positive net present value projects. But because of the constraints by the budget as approved by management, management has given us an approved capital expenditure. The amount you can spend on capital expenditure, management has given you an approval. That means once you have gotten to the budget level, even if you have a viable project, management said you must not spend more than 500 million capital projects. That means management has given you a ceiling, amounts to be invested on capital projects. The company has money. The company can borrow money. But the company has set a limit on the amount that will be used for investment projects. That means the budget has provided a ceiling, a constraint. Once the budgeted amount has been exhausted, viable project, a project with positive net present value, not sell project because you have been given an approved limit, amount you can spend on investment projects. That is soft capital rationing. This may be as a result of anything. Excuse me, please. One, management acting on behalf of the shareholders may not like to dilute control. Thus, it will be the company will be unwilling to issue additional equity capital. We have a viable project, a project with positive net present value. But because we are trying to avoid dilution in control, we refuse to issue additional equity finance. It may be as a result of this that we give rise to soft capital rationing. Number two, at times, management may limit investments to the level that can be financed from your retained earnings. At times, management may limit investments to that level that can be financed solely from retained earnings. We don't want to borrow more money. We don't want to issue new shares. Any project, our finance is limited to retained earnings. That has created soft capital. That means you are not willing to borrow. You are not willing to issue more shares. Banks are willing to give you loan. But on your own, you say you are not taking loan. You have a viable project to finance. Bank is willing to offer you loan. But based on management decision, bank refuse to collect loan. Look at number 3 reason. Reluctance of management to commit itself to large fixed interest payments. Loan. If you take a loan, maybe for 5 years, 10 years, you are going to be paying interest annually. Because management is not willing to be to large interest payments. They may try to reject additional debt finance. Even though we have gotten a viable project. Number last, limitation on spending based on budget approval. Most companies we set limit on spending. Most companies manage budgets. In budgets, there's going to be approved budgets for capital spending. That approved budgets has created a soft capital rationing. Our next discussion. We have explained the nature of capital rationing, hard capital rationing or soft capital rationing. Now, types of capital rationing. There are two major types. Single period and multi-period capital rationing. There are two major types of capital rationing situation. Single period and period capital rationing situation. What is single period? This relates to a situation where finance will only be constraints, will only be a limitation for a single period, just 1 year. A single period capital rationing situation. A situation where finance is in short supply. A situation where finance is in short supply only for a single period. After that period, finance is freely available. Maybe in year 0. Maybe in 2024. The company does not have shared finance. But after year 2024, the company will have sufficient funds. That means finance is only short. There's only scarcity of finance in 1 year. That is single period capital rationing. It could be year 0 or year 1 or any year. But that means we only be in short supply. That is single period capital rationing. Please note, if you are faced with single period capital rationing, if you are faced with single period capital rationing, projects will be ranked in terms of profitability index. That means we do not have sufficient capital to undertake all viable projects. The capital available is not sufficient to undertake all viable projects in a particular year. That is single period capital rationing. In this case, You are going to rank projects for selection on the basis of profitability index. The higher the profitability index, the better the projects. Your profitability index is calculated as the net present value divided by the initial capital investment. The capital investment. Your profitability index is calculated as the net present value divided by the capital investment. Or you can use present value of cash inflow divided by the present value of capital investment. Either method will give you the same decision. That is single period capital rationing. Please, just 1 minute. All right, thank you. There are two possibilities within a single period capital rationing situation. There are two possibilities within a single period capital rationing situation. You can have divisible projects. And you can have indivisible projects. Divisible projects. Projects that can be divided. Divisible projects. In this situation, it is assumed that a proportion of a project, can be undertaken, and proportion of the project's net present value will be achieved. Divisible projects. Where you are faced with divisible projects, it means that you can take certain percentage of the project and that means you can take certain percentage of the project profits. For example, a project that was 500 million, but I only have 250 million. I cannot take the whole 500. I only have 250 million. I can use my 250 million to do half of the project. I can invest my 250 million, that is portion, half of the project. Up to 50% of the project profits. That is divisible projects. Number 2, indivisible projects. Projects that cannot be divided. A fraction of the projects cannot be undertaken. Thus, we either accept the projects in totality or reject it. It is either you do 100% or you don't do the project at all. Like these ICAN projects. If you pass KISS and you have done professionals, they won't give you certificates. ICAN projects cannot be divided. It is either you are a qualified accountant or you are not. Some have gotten to final. They only have like 1 paper or 2 papers to write. Until they finish that paper, they cannot be regarded as a chartered accountant. And they are not qualified to be called chartered accountants. We have other projects, mutually exclusive, mutually dependent, independent. When we get to question, for your syllabus at skills level, only say we should look at single period projects, single period capital rationing. Your syllabus, as far as FM is concerned, if you check your study pack, ICAN study pack, the syllabus only cover single period. The syllabus only covers single period capital rationing. But you must be aware that a topic of multi-period capital rationing. There's multi-period capital rationing. Let me explain that briefly. This refers to a situation where capital is expected short supply for more than one single period, more than 1 year, multi-period rationing, a situation where capital is expected to be in short supply for more than one single period. In such situation, selection of optimal in program cannot be made by ranking projects according to profitability index. When you are faced with multi-period capital rationing, just 1 minute. When you are faced with multi-capital rationing, your project selection cannot be decided by profitability index. To address the problem of multi-period capital rationing, we are going to use linear programming. At this point, the calculation to derive an optimal solution becomes significantly more complicated. To solve this problem, to solve problem of this nature, a mathematical program will be required. You are going to use linear programming. If you are looking at divisible projects, but if the projects are not divisible, then you are going to look at integral programming. But this explanation is above your syllabus. So I'm going to stop it here. Let us focus on your syllabus. Your ICAN study pack. Your syllabus only covers single period capital rationing. So all the questions will be on single period. All right, we are done with the explanation. Any question? Where is Mr. the Governor? Mr. Jamil from Delta State. I think because of the rain, connectivity is a bit difficult. But we can't stop the class. All right, please refer to your study pack. Rationing. Question number 1. Please, can somebody confirm the page?
Page 90.
Can somebody confirm this page?
Page 90.
Okay, page 90, question 1.
No, it's question 6, illustration 6 on page 90.
That is not possible. I only have 3 questions there now.
Okay, well, maybe others should check, but that's what me I have. A company has 20 million. It's illustration 6.
That is page 90, illustration 6. She's correct, sir. On our own book, that's on our own handouts. That's how it is. Page 90, illustration 6.
The company has 20 million to invest. There are 4 projects available for investment. All similar in terms of risk. The amount of investment required and the net value of each project as follows. You have project A, B, C, D. Okay, let's go on. Suggested solution. Any project with negative net present value must be removed. That means project C is not viable. Look at this. Rejected. That means we are left with 3 projects, A, B, and D. Now, projects are all viable. Project A, MPV 3 million positive. Project B, 2 million positive. Project C, 4.2 positive. Assuming there is no capital shortage, we should have accepted all these projects. Now sum up. To do the 3 projects, 8 million plus 5 million, 13 million. plus 10 million. That means we require amounts required to undertake all positive NPV projects. The amount required 8 million plus 5 million plus 10 million, 23 million. Now go and check. Capital available. $20 million. Obviously, we don't have sufficient capital to undertake all viable projects. That means one of these projects may be reduced or rejected. You now go and calculate to know the project to be accepted. You need to calculate the profitability index of each project. Profitability index is calculated as profitability index is equal to NPV divided by the capital required. For project A, 3 million divided by 8 million. Please work this out. Oh yeah, oh yeah, oh yeah. Yeah, 0.375. For project B, 2 divided by 5. 0.4. For project D, 4.2 divided by 10. 0.42. When you are done, rank your projects in the order of the highest profitability index. That means project D first, project B second, and project A third. Now, if the project is divisible, requirement A now. If the projects are divisible, projects to be undertaken are, now follow your ranking. Projects. We are going to do project C first. Capital required is $10 million. Do cumulative. $10 million. When you are done with project C, we now go to project B, second ranking. Capital required here is $5 million. Cumulative, we have spent $15 million. The NPV here, NPV of project C, 4.2. For project B, 4.0. That not? No, 2 million. The NPV here, 2 million. We now come to project A. Remember, the total amount is 20 million. Amount available is 20 million. Out of 20 million, we have spent 15 million. And project, yes, Rose.
Yes, sir. I think we are doing it in order of ranking, Abi.
Yes.
And A is the second, not B.
Are you sure?
No, B is the second.
B is the second, but it's 4.
B is
Please go back
0.4
and
now.
check it. B is the second.
All right, sir. Okay.
Now, out of 20 million, we have spent 15 million for projects. We are going to spend 10 million for project C, 5 million for project B. Then for project A, we require 8 million. That means we cannot do the project A complete. Examiner says this project is divisible. We can only take 5/8 of project A. We can only spend 5 million for project A. That means project A, the total amount is 8 million. But I can only undertake 5 million of this project. Cumulative, that will give me 20 million here. That means for the profit for project A, the profit is the NPV. NPV of project A is 3 million. Since I will only get 3 million, if I can do 100%, which is 8 million, but I can only do 5 million of this project, that means you are going to prorate the NPV. Look at it. For A, we can only achieve NPV for A. We can only achieve 5/8 of 3 million. Since we are only going to do 5 million, if you work that out, 5 divided by 8 multiplied by 3, we can only achieve 1.875. We are going to invest 5 million. In percentage, that will give you 62.5%. We cannot do 100% of projects. But because the project is divisible, we can take a fraction. The fraction is 62.5%. Then you are going to compute 62.5% of the net present value. That is the amount we can achieve. That means if the project is divisible, our selection is accept project C, B, and 62.5% of A. Now the company will now achieve, please sum up. If you take this, add the MPV,
7.875.
7.875. Full stop. The company will achieve a total MPV of 7.875 million if the project is divisible. If the project is divisible, we can have this. I'm trying to expand this more. Play just 1 minute. I need to expand this. I'm going to check my chart. I can see a chart coming in. Or I think this is enough.
Excuse me, sir.
What is this? Sorry, please, what is this? Is it BAD or B? I don't know. I can't understand this. Maybe you can call it.
Size DBA, not CBA. In your remark, you wrote CBA.
Okay, let me check.
The project.
Oh, if we are not even taking, we are not taking C at all, safe. Okay. Accept projects DB and 62.5% of A. All right, thank you. That is if the project is divisible. The B part says if the projects are not divisible, that means we can't do fraction. B, if the projects are not divisible, then the company will accept project D and B. Look at it. Oh, this is not even C. This should be D. We are going to take project D, 10 million, followed by project B, 5 million. Out of 20 million, we have spent 15 million. We are left with 5 million. Examiner said the project is not divisible. You cannot accept fraction. That means the surplus funds we accept projects B and D, project D and B, full stop. The surplus funds in bracket 5 million can be returned to shareholders. Yes, your comments, Esther.
The total MPV, if the project is divisible, is supposed to be 8.075, not 7.875.
Oh, this should be 8 points. Okay. 8 points what?
0.075.
8.075. Oh, thank you. $8.075 million. So if the projects are not divisible, you are going to accept project D, that will cost you 10 million. Accept project B, that will cost you 5 million. That means out of 20 million, you have spent 15 million. Your surplus fund, 5 million, can be returned to your shareholders because you don't have any project for it. Or retain for other business use. That will be your recommendation. You are done with that question. So capital rationing is not a difficult topic. In fact, examiners say just focus on single period. The next question. Chief Dan Limited. Excuse me, please. Wow. You guys must pass well, though. Question number next. Chief Dan Limited. Let's look at this question quickly. Chief Danlimi said is considering an investment in the following projects. The cost and NPV of the projects are given below. You have Alpha, Bravo, Charlie, Delta, Echo, Foxtrot. You have like 6 projects. We have the initial investment cost, and we have the net present value of the project. The company only have 13 million naira available for investment at a cost of capital of 15%. Surplus funds are reinvested at 20%. You are required to advise Chief Dan on the project combination to select under the following conditions. 1, all projects are independent. Project Alpha is independent of Project Bravo. If all projects are independent, then we are going to still compute our what's it called? Profitability index. But to do that, first, go and confirm, is there a capital rationing? You are going to compare capital available with the capital required. All the projects are viable. All the projects have positive NPV. So we need to sum up. What is the capital required? You are going to sum up the investment cost. 1,800 plus 2,000 plus 2,500 plus 3,000 plus 2,800 plus 1,700. Please sum up.
13.8 million.
Wow, look at it. We come here. Capital require for all viable projects. Total 13,800. Capital available for investment 13,000. That means there's a capital shortage. That means there's a capital shortage. We cannot undertake all these projects. Because there is a capital shortage. In this case, we need to ration our available capital. Capital shortage. In this case, we need to ration available capital resource. Hence, you must compute your profitability index. calculation of profitability index. To save time, just copy this. To save time, instead of writing 1-1, come and place it here. I can also do this. I'll just do this one. Insert. To my right. Do one more. To my right. I can now move on. I will calculate profitability index and ranking. Your profitability index, MPV, divided by the investment cost, 1,080 divided by 1,800.
0.6.
1080 divided by 1,800.
0.6.
0.6. Next.
0.45.
0.45. Next.
0.65.
0.65.
65.
Next.
0.48.
0.48. Next.
0.48 again.
0.48. 1344. Or again. 0.48 again. 0.48. Next.
0.59.
0.59.
0.59. Now ranking. Starting from the highest PI. Charlie will confess. Followed by Alpha. Followed by which one now? 4848. Two of them, they will go together. But one must, that means it will give us the same return. Here we have 4 We also have 4. That means these two, they ties. But one of them can take 5. It doesn't matter. If I do delta first, or I do echo first, they will give me the same results. So you can take this as 5. Then Bravo will go last. If the project are independent, that means I'm going to select the first 5. I will start with assuming all projects are independent. This is a project based on your ranking. We are going to carry Charlie first. Projects cost is 2.5 million. Okay, let's follow the same pattern. Let's use the same pattern.
Sir, we can't see your screen.
Project. Can you see my rank 1? Charlie, the capital is 2,200. The is plus 1.88. Please sum up. Hello.
Your line is breaking, sir.
Can you hear me now?
We can hear you, sir, but the line is still breaking.
Can't see the board. Can you see the board now?
Yes, sir.
Yes, sir, we can see it now.
Now, you are going to start with the two
I'm not hearing anything again. I don't know if I'm the only one.
Same here too.
Asiwaju, we can't hear you.
All right, can you hear me now?
Yes, I can hear you.
Can you see my screen?
Not yet. Your screen has come
Okay,
up
yes,
now.
yes, we can not see it.
Can see now.
All right, let's go on. Now, based on the ranking, we need to select projects. Look at the ranking, please. First rank, project Charles or Charlie, 2,500. That is the cost. MPV, 1,625. You pick that, 2,500 capital require, cumulative 2,005, MPV 1,625. Project Alpha, second ranking, cost 1,800. Cumulative 2005 plus 18. What do we have?
That's
4,003.
43. MPV of project Alpha 1080. Rank 3. Project Foxtrot 3. Fox. Amount is 17. Cumulative 43 plus 17.
6,000.
6,000. MPV of project Foxtrot 1003. Ranking 4. Project Eta. Amount cumulative 9,000. MPV of Beta 1480. Rank 5. Fifth. Investment cost 28. 2809. That is 11,800. 1344. Examiners say these projects are independent. We are not told if the projects are divisible or not. We can only accept these 5 projects. The last project, Project Bravo, we require 2 million, but we have spent 11,800 out of 13. How much are we left with?
1,200. 1,200.
1,200. So we have a choice. If this project is divisible, we have a choice. We can do some fraction of projects. What is that project name? Bravo.
Bravo.
We can take some fraction. Look at choice. We have a choice here. We can do one first choice. We can accept 1,200 over 2,000. What is the percentage? 1,2 divided by 2,000.
0.6.
That is 60%. The line is fluctuating really. We can do 60% of Bravo. Look at it. We can do 60% of Bravo. That is 6. We can do Bravo now. 1,200, 60%. That will give us 13,000. That means we are going to take 60% after tax. %60 of 900 multiplied by 900. You can take this option.
540.
540. we can take 540. Or examiner says surplus funds. Look at it. Surplus funds are reinvested at 20%. If I reinvest my surplus funds at 20%, what's my return? Alternative, or invest the surplus funds in brackets 1,200 at 20%. Calculation. Return will be 20% of 1,200. Please compute.
$240.
That means we are going to get 40. Now we can calculate the NPV of this. Look at it. You are going to invest investments. You are going to investment 1,200. And return the discount rate of 15%. Cash flow. This is year 0. This is year 1 to infinity. Infinity. This is year 1. The same value will be 1,200. Then to infinity. Calculate present value of a cash flow to infinity. How do we calculate present value of a cash flow to infinity? Any idea? Factor. That is cash flow in 1 over distance factor. How to get that? Just come here. $240 divided by 0.15. That is how to calculate present value of face to perpetuity. It don't make me tired, you know. Get me tired. Wait, the thing is breaking down itself. If you want to calculate the present value of a cash flow, Please, can you hear me?
Yes, you can hear you, sir. Just how you may need to take the formula again. The line was network was skipping then.
Write it down. Present value of the cash flow. The cash flow divided by the discount factor, the discount rate. Look at it here. Present value of a cash to infinity, forever, is equal to the cash flow divided by the discount rate. Divided by the discount rate. In this case, my cash flow is 240. $240 divided by 15%. That will give you 1,600. That means I have 1,600 here. Our MPV, 400. You now compare the two alternatives. If you take a fraction of Bravo, you have 540. If you invert the sum of, you are going to get 400. Which one is better? Which option is better? It is silence. Can you hear me? Hello.
We can hear you, sir.
I'm not tired. Hello.
We can hear you, sir.
We can hear you, sir.
But if you don't respond, it get me tired. Because I'm
The
not
line
even
has
sure.
the line has been breaking. We couldn't hear most of what you have been saying, sir.
So we can call this class off for today. It's tiring. So the only impact is that we can't shift the exam dates. If the comment is that you cannot hear most of what I'm saying, it's as good as that we have not done this topic. And I cannot guarantee what network is said next week. Cannot say that the connectivity will effectively next week. And I won't change the date of the exam. Which solution? The solution that you are not even following.
I've been following.
So I've been trying to ask a question. Up to this point, we have selected 5 projects. But we are left with 1,200. Are left with 1,200. Now the question is, how do we invest this 1,200? Should we take a fraction of the project? Yes. The project is the total amount is 1,000. We can do 1,000 represents 60%. Then you are going to claim 50% of the MPV. We now say compute 60% of 900. That gives us 540. That is option 1. Alternatively, examiner says invest surplus funds. You can reinvest surplus funds at 20%. Your surplus fund is 1,200. If you invest your surplus funds 1,200 at 20%, what is your return? If you invest surplus funds at 20%, your return, compute 20% of 1,200. Your annual return is 240,000. That means our annual return is 240. That gives I'm going to invest 1,200 in year 0. I'm going to get 240. This return for year 1 to perpetuity. You are going to get year 1, year 2, year 3, forever. We now want to calculate the present value of this alternative. You are going to invest year 1,200. Examiner says the company's cost of capital is 15%. This is the discount rate. I'm invest 1,200 in year 0. Discount rate of 10%. The value in year 0 is to get 40 on year 1 to perfect forever. And now ask a question. You need to calculate present value of a cash flow. year 1 to perpetuity. To do that, the formula is divided by the distance. Our flow is the return, 240. The discount rate is 15%. And the present value of flow is 1,600. We here 1 divided by you multiply this by 2, you are going to get 1,006. That means the second property, the alternative to PV is 400. You compare. If I take a front row, I'm going to get NP of 540. Alternatively, if I invest this money, this source for 1,200 on another investment, I'm going to get NPV of 400. Which alternative is better? Which of the two alternatives is better?
$540.
540. That means you are going to take option. The option of fractional contracts. Project is divisible. You are going to take this option. But if the project is divisible, that means you can't take fraction. Look at it. If the projects are divisible, Chief Dan should accept, should undertake projects. Let's go to it. Projects orderly alpha folks should undertake projects charts. Data and echoes. Data echo and 60% of the total PV will be, now please, if you can hear me, PV, please solve for 1 3, 4, 5. Then plus 540. 1625 plus
704.
0 plus 1003 plus 1450 plus 1344 654. Then plus 540. Then I'm going to have 656. The project divisible. The MP 6556.
So I'm getting 7042.
Maybe I'm wrong. Can somebody know?
042.
It is correct. For provided the proof alternatively, if projects are not divisible, if the projects are not divisible, then Chief Dan should undertake Charlie Foxtrot Delta Echo and invest surplus funds. Surplus funds and reinvest surplus funds at 20% return. This value of 400. Therefore, total MB will be if this figure is correct, 7042 minus 540 plus 400. Then we are going to have 6902. 6902. You are going to remove this 540, replace it with 400. Because I said the projects are not divisible. So sum up, remove 540, introduce 400. The 400 from surplus funds. What is the total NPV?
6902.
Let me check this. 1625 plus 1080 plus 1003 plus 1450 plus 1344. Okay, it's correct. Plus 4. Yeah. So that will be the solution. If the projects are independent, and we are not done with the question, no. Okay, let me see. We have this. Now look at if projects ECHO and phosphorus are mutually exclusive. What is the meaning of mutually exclusive? When we say projects are mutually exclusive. What does that mean? It means that if one project is accepted, the other must be rejected. Mutually exclusive projects. The two projects cannot be accepted at the same time. That means if you accept project E, you must reject project F. If you accept project F, you must reject project E. To answer this question, you are going to create two groups. Group 1, if I accept project E, what is the total NPV? You go to your ranking. Based on ranking, project first must come third. You are going to take project. Look at, let me do the grouping. Maybe this can help. Maybe this topic should go more than one lecture. Assuming Echo and Foxtrot are mutually exclusive. That means you are going to do two groups. Mutually exclusive projects. The two projects cannot be accepted at the same time. You now do group 1, where project Echo is considered. That means I can't take project Fox again. In this case, the project will be selected. We are going to start with Charlie. Amount is 2,500. Capital required. Cumulative is 2,500. The NPV here is 16250. You go to Alpha. Amount is 18. Cumulative is 43. NPV is 1080. The third project is based on ranking. The third project is Foxtrot, but it's mutually exclusive. I can't take this project because I'm going to consider equal, or I'm going to consider this E. So you are going to ignore this project. You now go to rank 4, data. Amount is 3,000. Data. Amount is 3,000. That will give me 7.3. The NPV of data $1,450. $1,450. They are moved to this E. Project amount is 28. NPV 1344. Amount here is 28. Cumulative 73 plus 28.
10,100.
$10,100. NPV here 1344. Then we have Bravo. Bravo will cost 2 million, 2,000. NPV 900. Bravo 2,000. Cumulative 12,100. 900. We cannot accept project Foxtrot because the project is mutually exclusive. Out of 13,000, we have invested 12,900. The balance, how much is the balance? We
900.
come here. Look at surplus funds. Don't worry. Out of 13,000, we have invested 12. That means we are left with 900. Examiner says surplus funds can be reinvested at 20% per annum. So we are going to reinvest surplus funds. Expected return. %20 of 900. Please compute how much.
$180.
You are going to get 180 and oh, not percent. 180 annually. Forever. Look at the NPV of the investments. Why? Not even have. I'm just trying to expand this. Oh, I didn't even expect this to be so stressful. Look at it. In year 0, you are going to invest 900,000. This is your cash flow. This company's cost of capital is 15%. The present value in year 0 is 900. Then year 1 to infinity, you are going to get 180. 20% of 900. Discount factor here, 1 over 0.15. That means divide 180 by 15%.
1,200.
180 divided by 0.15. Thank you. The present value is 1,200. The difference will give you the NPV. That's how much?
300.
300. That means if you take the first option, you are going to just come here. Surplus funds invested. Surplus funds 900. Total amount 3,000. We are going to get a return of 300. Now sum up. If you take option 1, sum up. I have like 2 minutes.
6,699.
This option will give you 6,699. Please allow me to do something to reduce. Yeah, I can take this off now. Can I take this off? Let me take this off here. Surplus funds 13 minus 12,100 900. This is option 1. Look at group 1. The projects are mutually exclusive. Once you do this E, you cannot do full stop. Group 2. Honestly, this is not a topic that we should take to next week. But if you don't have choice, because we are in October, by the design of your syllabus, by the design of this syllabus, we should be rounding up ending October. Even tired. Let me just do like 2 more. Can you imagine? Group 2. Where first trust is considered. In this case, you can consider the other projects. So your project, we are going to start with Charlie, capital amounts 25, cumulative 25, MPV 1625. We move to Alpha, capital amount 18, cumulative 43, return MPV. Then number 3, based on ranking, first row, what is the capital cost of the project?
17.
17. What is the MPV?
1003.
This is 17. Our cumulative is 6,000. Is that not?
Yes, sir.
1003. Then project 4.
Delta.
Delta. Amount is 3,000. 9,000. MPV 1450. We can accept project E because it's mutually exclusive to project first trust. That means we have to go to
Bravo.
Bravo. Amount here is 2,000. That will give us 11,000. Project return, how much? MPV
900.
Then surplus funds. Out of 13,000, we have spent 11,000. The amount available for investment is 13,000. That means our surplus fund is how much? 2,000.
2,000.
Is it clear, please?
Yes, sir.
Now, this surplus fund, examiner say you can reinvest it to get a return of 20%. Look at it here, please. I can take this down small. Working. Investment of surplus funds. Return on surplus funds. Return 20% of 2,000. Please compute.
400.
That will give us 400 annually. Find the NPV. In year 0, you are going to invest 2,000. The discount factor, 15%. This will give you 2,000 negative. Year 1 to infinity, you are going to get a return of 400. This is 1 divided by the discount factor. 400 divided by 15%. What is the present value?
2667.
2667. That means the NPV of this surplus funds, 667. If you invest the surplus funds, you are going to get NPV of 667. Now sum up. Let me move up small.
Six, 725.
6, 7,
725.
2, 5.
5.
Now compare the two groups. Which of these one will give us the higher NPV? Which of the project combination is better?
Group 2.
Look at the first group, 6699. The second group, 6725. 67 is better. Is that not, please?
Yes, sir.
That means if you want to advise Chief Dan should use the second combination. Recommendation. Chief Dan should select the group 2 with higher total NPV, 6725. Oh. Obviously, we are going to stop here. Even though we are not done, no. We stop here. We still have the third scenario. Project Bravo and Charles are mutually dependent. We shall stop here. Based on the that means we are going to take a class next week again. Although I wish that we don't have to waste that time. All right. Any question? You can try to go through it. May God give us a better understanding.
Amen.
Amen.
Hopefully next week, we round up this topic. All right, good night.
No, sir.
And
Thank you, sir.
remain blessed.
Yeah, sir.